I think gold's going higher, and Nigel's correct. In fact, in terms of sterling, gold hit an all-time record high in 2022. And remember, when the Exchequer sold almost all of Britain's gold, the price of gold is now up tenfold in sterling since that horrific blunder was made, and it will go down in history as probably one of the worst mistakes that a central bank has made. But, I think that one of the reasons that we haven't seen a stronger dollar gold price is just because investors are still confident that the Fed is going to succeed in bringing down inflation, and they will fight as hard as they need to win the battle. And so investors are not worried about inflation. They're worried about the inflation fight. They're worried about how high rates are going to go to win that fight. And they're looking at that as being negative for gold and bullish for the dollar. But I think once investors accept reality here, that the Fed cannot raise rates enough to bring down inflation, that it will bring down the economy long before it brings down inflation, and so it will go right back to the printing presses, investors will start to buy gold because now they're going to fear that not only inflation is here, but it's going to run out of control and it may become hyperinflation. And I think the demand for gold is going to skyrocket. And especially once you no longer have the sideshow with crypto, because I do believe on the margins, there were some people who might have bought gold, who bought Bitcoin instead. They thought they were buying digital gold. They ended up buying fool's gold. And so when nobody is buying fool's gold anymore, then a lot more people will buy the real thing. Well, I think, we've made a lot more enemies, or maybe emboldened our enemies in 2022. And I think we've created an even greater incentive for the world to divest itself of the U.S. dollar and move off the dollar standard. That's really the secret of the U.S. economy. It's our ability to just print money and just export it and use it to buy goods that we didn't produce. Our economy just is not capable of manufacturing. So we live off the industrial might of the rest of the world, and we've conned them into accepting the paper that we just create out of thin air. And I think they're going to become less reluctant to accept that. And, geopolitically, this has major ramifications for the United States and its ability to really impose its will and the degree of force that we have around the world, because we won't be able to finance it without the world bearing the burden. And I think this will be a positive development, especially for the emerging economies that really bear a lion's share of this burden. The countries that produce so much stuff that they don't get to consume because they send that stuff to America and import our inflation instead. I think as the dollar collapses and you get a lot of these emerging market economies, currencies rising dramatically, that will be a huge benefit to the people living in those countries as their purchasing power and standard of living rises. The opposite will be happening in the United States. Our purchasing power and our standard of living will be falling. I think the Eurozone probably has even bigger problems than the UK. Probably one of the best things the UK did was get out of that the Eurozone, but they're their own worst enemy as well. I met a lot of British expats when I was in Dubai, and these are people that it's a shame that the UK lost them, but it's no accident. The corporate income tax is zero, the personal income tax is zero. But it's not just entrepreneurs who are benefiting from low taxes relocating to Dubai. It's lots of people who are moving to Dubai to take advantage of all the jobs that are being created by all these hardworking entrepreneurs. And so that's what we need. We need more free market capitalism and more personal responsibility. But the problem with getting there is that even the conservative or the populist politicians don't want to level with the people who are getting government benefits. Like Nigel said, the dog has the bone. Nobody wants to take it away. Even the people that supposedly represent smaller government won't shrink government. Nobody wants to talk about cutting Medicare, Social Security, even Obamacare now, nobody will cut. So government is going to keep on spending, and we're not going to be able to solve any of these problems until we rein in government. Just cutting taxes doesn't do anything. It just substitutes inflation for taxation. And in many cases, inflation is an even worse tax, particularly on the people that it impacts the most. Well, I'm optimistic on certain markets. I think the emerging markets, to me, in general, look very cheap. And if I'm right about the dollar beginning a new long-term bear market and ultimately hitting new all-time record lows within the next couple of years, I think emerging markets are going to to do very well. I think commodities are also going to be strong. I think we've had a bit of a pullback, but I think we're going to see much higher prices across the board: energy, industrial materials, agriculture. So investments in those sectors and countries that are rich in those resources should do well. And I think the countries that have the comparative advantage in economic freedom will do well. Countries that have low government debt, low taxes, minimal regulation, surpluses in trade, these countries are going to thrive. And I think their stock markets will do well. And so I think people who invest in those markets will be rewarded. But I think if you're going to invest looking in the rearview mirror in the type of stocks that worked during the bubble days of 0% interest rates, and where just anything with a ticker went up and people just chased momentum, none of that's going to work. So if you don't recognize that era is over and you're just hoping for these stocks to come back from the grave, you're going to go nowhere. I mean, people have to recognize that they need to cut and run from a lot of these stocks. Even if you're down 50, 60, 70% in some of these tech stocks, it still makes sense to sell them, because you can make those losses back if you invest in the right stocks. You don't have to make the losses back in the same stock where you lost the money. In fact, if you hold and hope in those stocks, you're probably going to just lose even more.
Yeah, well, I think the economy is in horrible shape. I think that's one of the reasons that President Biden is so unpopular, because I think a lot of the people who are struggling in this economy, in part, blame the president. He's not solely responsible, but he certainly hasn't done anything to help. Everything he's done is actually taken a bad situation and made it worse. But if you look objectively at the data, the savings rate is at the lowest it's been since 2007. I think it's down to 2.3%. So Americans have blown through all their stimulus money, and now they're pretty much broke. If you look at credit card debt, it's at an all-time record high. So Americans are struggling to put food on the table and to pay the electric bill, and so they're borrowing more money on their credit cards. If you look at what's happening to wages, they are declining in real terms. And I think the real decline is being masked by the fact that we are understating inflation. I think the actual inflation rate is about double what the government will admit to. And that means that the real decline in wages is much greater, which explains why so many people are now moonlighting. A record number of Americans have 2 and 3 jobs. In fact, you have more Americans than ever that are working 2 full-time jobs. Most people don't want multiple jobs. They would prefer to be able to support themselves and their family on 1 job. But unfortunately, in the Biden economy, that's not possible. And that's where all these jobs that are being created are going. They're going to people who don't want more jobs, but who are forced to take them anyway, because that's the only way that they can keep up with the rising cost of living. The savings rate, again, is 2.3%. That's the most recent number that was released last week by the government. We haven't had savings that low since 2005. But one of the reasons that Americans weren't saving in 2005 is because they had so much home equity. They were just getting rich off the real estate. That was the peak of the real estate bubble. But right now, Americans are losing their home equity. Real estate prices are now falling. But what's more problematic is real wages are falling because the cost of living is going up, and credit card debt has exploded. So if Americans really had all this savings, credit card debt wouldn't be skyrocketing. The reason credit card debt is going up so much is because people don't have savings. They can't afford to buy things. They have to borrow the money. But more of the money that they're borrowing is being spent on food. It's being spent on electricity, on gas. I mean, look at all the big retailers that are reporting that their customers are spending more money on food and less money on everything else because food is so expensive. Looking at credit card rates now that are about 20%, and that is a huge amount of interest to pay. And I think a lot of people today have a lot more consumer debt than just their credit card debt, because over the last few years, a lot of these buy now, pay later companies have come up into existence. And so people are using those companies to buy stuff without money, but it doesn't show up in the credit card numbers because it's not credit card debt, but it's still debt that the consumer is obligated to repay. And I don't believe they're going to be able to do it. So if you don't pay it, the credit card company, they can't come after your assets. They can't put a lien on your house or try to go after your IRA. So the debt is, very difficult to collect if the person doesn't have any money. It's also dischargeable in bankruptcy. So we haven't seen a big spike up in credit card delinquencies, but I think that's coming in 2023. And what also happens with credit card debt is once somebody with credit card debt recognizes that they can't pay it back, and they've decided they're not going to pay it back, or that they're going to file for bankruptcy, what they will do before is max out their credit cards. They'll just borrow as much money as they can, because whatever they're buying, they're getting for free, right? So if you're planning on going bankrupt and you have $50,000 worth of credit card debt, but you still have another $50,000 that you can borrow, well, you're going to do it. You're going to go out and spend the other $50,000 and buy as much stuff as you can, because when you go bankrupt, you don't have to return that stuff. If you go out and you buy a bunch of clothes and some consumer electronics or take a vacation, and then you file for bankruptcy, you don't have to give any of that stuff back. And it makes sense that before you file for bankruptcy to buy as much as you can, because once you declare bankruptcy, you're not going to get any new credit cards for a while. So you might as well buy everything you can before you go bankrupt. So you get that moral hazard that's going to accelerate the losses for the banks that are issuing the credit. I think we're already in a recession, and the rate increases that you're talking about are partially responsible for that recession. I think the recession is going to get a lot worse. Now, that doesn't mean the Fed shouldn't be raising rates. They should already have raised them a lot more than they have. The problem was they never should have cut them. That was the mistake. It was cutting rates. Raising them back up is really just an acknowledgement of that mistake. But what happens is when the Fed raises rates, it uncovers all of the problems that it created when it reduced rates. Because when it slashed interest rates to zero, it inflated a bubble economy, and it inflated it with inflation. Quantitative easing was inflation. It's just another word to describe inflation. It's just that a lot of people don't realize that it is inflation, because inflation has a bad connotation to it. And so quantitative easing doesn't sound as bad. If the Fed said our policy is to create inflation, the public would have said, wait a minute, I don't want inflation. So if they say, well, our policy is quantitative easing, then you don't have as many people critical of the policy. But we're now experiencing the consequences of that inflation, rising prices, and prices still have a long way to go. And that's one of the reasons I think that the recession is going to get a lot worse, because more consumer income is going to be diverted to necessities like food, energy, rent, insurance, things like that. And interest rates are going to have to keep rising. And that's also going to take a lot of purchasing power out of the economy, because people have to service their debt. And if you're spending money paying interest on the money you borrowed to buy stuff in the past, you have less money left over to buy stuff in the present and in the future. And that's what helped bring about a more severe recession. Most people who own stocks, unfortunately, own the most overvalued stocks. Big tech, for example, those are the stocks that went up the most because interest rates were zero, and people thought that inflation would be low forever. Well, now that interest rates are not zero and inflation is here and getting worse, those stock valuations are coming down. I think they still have a long way to fall. So most people will lose money in the stock market. I think they'll fare even worse in the bond market. Even though yields are higher now on bonds, they're not nearly high enough to offset inflation. So people are going to lose a lot in bonds. So they have to start thinking outside the box and look towards alternative types of investing. You can still invest in stocks, but you can't invest the indexes that are so dominated by overpriced tech names. You have to, be, more discriminating in the stocks you buy. You have to select the stocks based on value and dividend yield and just build your own portfolio rather than just, buying these indexes. And I think the best values are had abroad. I think the highest dividend yields are outside the U.S. And I think that also gives you the benefit of a hedge against what I believe is going to be a very weak U.S. dollar. The dollar is up on the year, but it's losing those gains rapidly. But I think over the next several years, we're going to see a very weak dollar as the markets come to terms with the reality that inflation is not only going to get higher, but it's here to stay. It's not going back down to 2%. And that's going to result in a run on the dollar, I think, and on U.S. dollar-denominated assets, especially when the Federal Reserve actually has to go back to quantitative easing, which is creating more inflation